Is the deal king of investing in free of title issues, fraudulent documentation, bad actors? How do you know? My guest today, Sarah Hanks, CEO of the company CrowdCheck, helps sponsors to reduce liability and ensures investors are protected. Welcome to the National Real Estate Forum podcast, episode 220. Thank you for joining me today. I'm Dr. Adam Gower, and this is the Crowdfund project at nreforum.org, where developers, investors, and industry leaders share insights that you can use to raise capital, build wealth, and earn passive income from crowdfund real estate deals. When the Securities Act was passed in 1933 to protect investors following the 1929 stock market crash and subsequent Great Depression, the idea was to create a distinct dividing line between the public and private sectors. If you wanted to sell your company or to raise capital for your deal from the general public, you still could, only it would now be heavily regulated and controlled. The process became very time-consuming and costly, and reporting requirements were made to create a high level of transparency which, the idea was, would provide an insider's look at the company going public, so that all material facts were fully disclosed. The flip side of the Securities Act was that you could still raise capital from private markets, but that private meant private, meaning that someone raising capital this way had to raise it exclusively from people they already knew, i.e. from their own private contacts. Over the decades since 1933, in real estate at any rate, these private networks became domains inhabited only by a very small high net worth proportion of the population and were consequently cloaked in secrecy, at least from the general public's perspective. Okay, so now here comes along the Jobs Act of 2012, which reversed the regulations regarding public solicitation. Now, if you want money for your deal, you can openly advertise without having to be concerned about the reporting restrictions previously imposed on such public solicitations. Public solicitation was again made possible without having government watchdogs peering over your shoulder to make sure you were fully disclosing everything that you need to. This sounds on its face like a reversion to the wild, wild west of the pre-1933 Securities Act that was designed to protect the public from unscrupulous or incompetent operators. But one main difference is that in 2012 there was a different form of disclosure, that of the internet, where everything is public because people talk openly online. If an operator is not being forthright, the crowd's collective intelligence will alert the masses. People will investigate deals and then share their findings in open forums, enabling a kind of crowdsourced insight into the terms of the deals, the due diligence and the background of the sponsors. Well, that's the theory anyway. Check out the background to CFRE and how you can benefit from it by going to the show notes for today's podcast at the nationalrealestateforum.org website, nreforum.org/SARA, S-A-R-A. My guest today is Sarah Hanks, CEO of CrowdCheck. Sarah fills the gaps that decades of private development deals have laid bare by helping sponsors make sure that their paperwork is in order before they go out to the general public for capital. I can see how sponsors can be lackadaisical about this kind of thing. It's rather boring. Is there truly clean title? Are my LLCs all in order? Are the structures that I've put in place the same as those I've trivial? I've worked on thousands of deals, and the ones that end up in the greatest distress when the tide goes out are those where the overall administrative processes were the worst. If a sponsor can't get basic paperwork right, what else are they missing? Unless, of course, a sponsor knows exactly what they're missing and doesn't want you to know, in which case, well, you'll just have to hope it won't matter, or otherwise just be satisfied to find out when it's too late. CrowdCheck offers certifications that sponsors can use and that investors can see. There are links to their website at the show notes to today's episode at nreforum.org/SARA, S-A-R-A. And don't forget to complete the form at the top of the page for a free summary of crowdfund real estate, where it comes from, what it is, and how it benefits you. That's nreforum.org/SARA.
Okay, well, I am a corporate and securities lawyer of 30 a lot standing. And I was a partner for many years at the London-based firm Clifford Chance in the DC and New York and Sao Paulo offices, usually simultaneously. And I was getting to a stage when the financial crisis started of getting close to the age at which many partners in the firm retire. And when the financial crisis happened, it was just, there was no work going on. It was really boring. And I happened to run into a friend at the airport who mentioned that her husband worked for Elizabeth Warren and the top Congressional Oversight Panel. And I said, that sounds interesting. And she said, they need someone who understands Wall Street. And I said, her husband worked for Elizabeth Warren and the top Congressional Oversight Panel. And I said, that sounds interesting. And she said, they need someone who understands Wall Street. And I said, here's my resume. 2 days later, new job. And that was in fact the week that the Dow Jones hit bottom, although we didn't know that till later. So worked for 18 months on oversight issues on Capitol Hill, and then never quite made it back to big law. What I had found in the practice of law in the traditional capital markets on Wall Street was that you're solving the same problem again and again and again, and it got kind of boring. I loved my clients, I loved my team, but it was always doing the same thing. And so I spent a big part of 2011 trying to decide if I was retired or not. And at that point, all of the various pieces of legislation that eventually... That's interesting. There's a lot of challenges there. Talking to friends at the American Bar Association who said things like, oh my God, they're going to defraud my grandmother. And started to think, well, I think I might have a solution to the defrauded grandmother problem, and I think I might be able to provide it. And started talking to a couple of friends that I knew through the Congressional Oversight Panel, and we set up a company to provide reassurance to people doing crowdfunding that the companies were legitimate. And from that point, we've kind of expanded, and we do now all aspects of compliance for online capital raising, whether it's under Regulation CF, Regulation D, 506C, or Regulation A. And although we didn't initially found CrowdCheck as a law firm, it's not a law firm, because we were securities lawyers by background, people kept asking us securities law questions, and we eventually started thinking, well, we could actually get paid for this. We do have licenses to do that. So we set up an in-house law firm. So we do a complete legal disclosure compliance package for all aspects of Jobs Act type fundraising.
Right, so let me jump back briefly. You said that you saw the Jobs Act in development and that you thought it was interesting. What was it that you found interesting about it?
It was the ability to democratize the capital raising process, to permit everyday people to take control of their own financial lives. And for early stage companies or projects, real estate included, to not just go to people who they always go to, the guys at the country club, wherever, but to reach out using the internet by give people more investment opportunities. So it seemed like a good thing on both sides, both for the company or project and for the investors, providing it was done in a compliant way, and providing that everybody knew what the risks involved were, which is, where we saw ourselves coming in.
All right, so from the compliance perspective of the three titles, which are the most onerous and which are the easiest to comply with?
Well, the easiest to comply with is probably Reg D, because there's really nothing there. So assuming that we're, you're going out to accredited investors only under 506C, I mean, the only rules there are just don't lie and don't make misleading or fraudulent statements. So that's the easiest, but you do have to make sure that you present the information in the way that new investors understand it. Because just because somebody is accredited, we know from SEC studies that there's 12 million accredited households out there, but we also know that only 500,000 or so regularly invest in early stage projects. So there's a big disconnect there, and then some accredited folks who shouldn't be investing in anything or have no interest. But there is a whole new investor class out there. And so the challenge in Reg D is making sure that people who are new to this understand what they're getting into. And then, of course, the next level of complexity is Regulation CF and then Reg A on top of that.
Don't forget to pick up your free PDF summary to crowdfund real estate and how you can benefit from this industry at the show notes for today's episode at the nationalrealestateforum.org website, nreforum.org/SARA.
So this idea that
.org/SARA.
So this idea that you have 12 million accredited investors, how does the SEC reconcile the contradiction between its own definitions of somebody who is sophisticated and the actual reality of somebody who is sophisticated, as you've just described, do you suppose?
I don't think they've ever really tried to reconcile. I mean, if you look at the all of the documentation that came out when this concept was introduced, the idea of an accredited investor was supposed to be a proxy for someone who either had experience or could buy experience. They were rich enough to be able to hand this over to a financial advisor and say, "Tell me, financial advisor, is this a good thing for me or not?" And it was always an incredibly blunt tool. And I think the SEC has recognized that for quite some time. Owning of various sums of money or earning of various sums of money does not necessarily mean that you are automatically able to make investment decisions. And also the flip side, that there can be incredibly sophisticated people, many SEC staffers among them, who aren't accredited yet, but could make just as good decisions. So I do expect, especially with this change in leadership at the SEC, I do expect that the definition of accredited investor will probably be expanded at some point within the next 12 to 18 months.
In what way do you think it will be expanded?
I think they'll add a level of sophisticated, sophisticated by reason of examinations. So people who hold FINRA examinations, for example, should clearly be included. And business experience is one possibility. I don't think they're going to be business experience is one possibility. I don't think they're going to be too doctrinaire about it. I don't think they're going to say, Series 63, but not Series 69 or something like that. And I'm crossing my fingers as I say that. But I do think there's a sort of more flexible attitude in the leadership of the SEC now.
So irrespective of income or net worth.
Mm-hmm. Yeah. That's what I would expect.
Okay, yes, that would be interesting, wouldn't it? So, Sarah, actually, let me just back up a little bit and ask you, so how much were you involved in the, I want to say, drafting of the Jobs Act, if at all?
I had some input to Title III, which is the crowdfunding Regulation CF one. But I must say that, people talk about it was worked on for years and years and years, blah, blah. It changed tremendously. I remember marking up in March compared to what was in April. It changed a lot, which is part of the reason why it's not necessarily a perfect piece of legislation.
What do you think will be, I'm jumping ahead actually a little bit, but to stay, on this subject. So what do you think will be the major impetus for changes to these regulations, if any? I do have something in mind, especially when I think about real estate. So I just wonder, without putting words into your mouth, I was just wondering if you had any thoughts about what could trigger some significant changes.
Well, some of the most significant changes that are on various people's wish lists can only be instituted by Congress, and we see how that's working out right now. I'm not too hopeful. There could be one or two minor things where the House and the Senate are desperate for a bipartisan. There could be one or two minor things where the House and the Senate are desperate for a bipartisan win of some kind to say, here we pass this little tiny piece. So there is a possibility, for example, that special purpose vehicles might be permitted to be used in Regulation CF, for example. That would be on my list. And then there's one or two things with respect to accredited investors that I see kicking around, the House especially. So there could be some minor chipping around the edges of the Jobs Act to expand it a little bit in several different places. The thing on the flip side, though, to the extent anything goes really, really wrong, then you could see some pulling back. But that would take some time. First there has to be the scandal, everybody has to know about the scandal, and then they have to pass the regulations to address it. So for the next couple of years, I see minor fiddling with it.
All right, good. So maybe we'll come back to that when we talk about real estate and your long-term perspective. But, my focus, of course, is on real estate. So I'm interested to know what experience your company has in that space, and particularly what you've seen and what kind of compliance issues you've seen or can talk about for particularly real estate.
Sure. Real estate's kind of interesting. What we do in real estate is the really boring bits. We do the corporate diligence to make sure that the entity that owns the property was properly organized, and then the entity that is issuing the securities was properly organized, and that the two of them have a relationship. I mean, the standard structure that we see in real estate is property-owning company, which may be an LP, limited partnership, or it may be an LLC, and then the crowd holds interests in the LP or LLC that holds the property. So we check to make sure that all of those are properly incorporated or organized, and that they have authorized the issuance of the securities at both levels. And what we very, very frequently find is that the paperwork around the property-owning entity especially can be very sloppy. So, for example, you'll have, limited partnership number 4 owns property number 3, and you've got the issuer going out saying, we're selling interests in property number 2. So there is a tendency sometimes in real estate for successful sponsors to just pull out the last set of documents and mark them up and not do it completely.
Yeah.
So we do see that a lot. And another area that we do see that a lot. And another area that we see is the use of cascading pyramids of limited liability companies, LLCs all the way up. Because, of course, one of the things that we have to do is check that nobody who is a, quote, bad actor is involved in the sponsor. And sometimes we will see, several different layers of LLCs which may have been used in order to disguise the fact that there is a bad actor involved who didn't want to be disclosed. And you do have to go, our rules are we have to go all the way until we hit a human being or an incorporated company. And so anyone who comes to us with a pyramid of LLCs will find that we just go through all of the LLCs. So we do see that used occasionally. We do the boring and annoying bits because we're going to be asking for more paperwork.
Right, so I take a look at all these platforms, marketplaces, and they all have deals on their websites. How many of those are you involved in? I mean, there's no mandatory requirement for somebody as competent as you to be involved in any of these, right? Seriously.
That's right. And it is, one of the things that we're constantly, is a constant challenge to us, is the fact that services like ours aren't mandated. And a lot of these platforms have very limited resources, and they're not making a huge amount of money. And so some services like ours are kind of, a luxury to a certain extent. Although, we could argue that not being sued for sloppy paperwork is not a luxury. So with respect to how many platforms, it varies tremendously. You look at, say, 2.5 years ago, probably, we were probably working with maybe 12 to 15 real estate platforms. And I think of that...
You're kidding me. You know what? To me, this is the crux of the opportunity, but also the whole idea to me anyway, that this is kind of Wild West with the Jobs Act, particularly as it applies to real estate. How could, in the last 2 years, how could you fail in real estate? Right? You have to try.
Yeah, well, I think the answer for a lot of them was deal flow. I know that a lot of them had problems getting enough projects up. And if you've only got one or two kind of sad-looking condo complexes on your site, people are going to come to your site and go, "Oh, this is the same one that was there that 12 months ago." And so there's, some of the platforms we were working on, in theory they're still there. I mean, you can find them online. It's just that nothing has changed for 12 months or more, and a lot of them are just holding on, hoping that someone will buy for 12 months or more, and a lot of them are just holding on, hoping that someone will buy their technology.
I see. You don't look at the caliber of the deal or assess the caliber of the deal in any way, do you?
Yeah, we. I mean, that's what I was really referring to, and I said we do the boring bits. And we're not looking at, we're not making any predictions. We are, in fact, a registered investment advisor, so we do have a license. We could say this is a good investment or something like that, but we tend not to, since we aren't true real estate experts. And we prefer to leave that kind of analysis to folks who grew up in the business and who are real estate folks. We're really focusing on the structure and making sure that all of the bits and pieces are in place. And corporate stuff, does the property owner own the property? Are there any liens on the property? Is there analysis or anything like that? We leave to the platforms, which is it worked very well in the early days because it was the platforms were formed by real estate folks.
What worked really well?
The split of work between us and the platforms. The platforms would focus on, is this a good investment? What does the traffic look like? They would look at sometimes at zoning and stuff like that, and we would do, as I say, the boring stuff.
The compliance side. I see.
Yeah.
Okay, so let me ask you a real practical question. When somebody invests in a Reg D deal versus investing in a Reg A deal, what are they actually buying? Are they buying a share in a company, or are they buying a fractional share in a piece of real estate?
It's most likely to be a security, so if a share in a company. I'm not aware. So if a share in a company, I'm not aware of any of the real estate crowdfunding platforms who actually sell actual pieces of real estate, because that would be very difficult to track. Although one thing I'm hearing about is the use of blockchain to divide up property interests and sell the bits of property. I'm not sure that actually works. I'd be interested to see how that's going to work from the point of view of registration of interests of securities, but of real estate. But in nearly all cases, when somebody is investing on a real estate crowdfunding platform, they are buying shares or limited partnership interests or LLC interests.
Okay. So you've written a very interesting article recently, this article on the lemon squeezer.
Right.
I'd love you to tell me a bit about that, especially if you've seen.
Right.
I'd love you to tell me a bit about that, especially if you've seen anything similar in real estate. I remember, probably, I don't know if I'm dating myself, but I remember seeing these late night infomercials of some fellow sitting in a hammock, presumably in Hawaii, with a yacht behind him, explaining how to make money in real estate with no money down and how much money he'd made. Mm-hmm. And that lemon squeezer story sounds a bit similar. So tell me about that, and especially, like I say, if you've seen anything in real estate. Right.
Well, in fact, it was there were 3 companies involved in a series of discussions that I'm aware of with the SEC. 2 of them were real estate companies. And the Lemon Squeezer article came out as a result of a fuller understanding of just how far the SEC would let people go when it came to high pressure kind of very flashy ads on TV. And in fact, I've seen the TV ads, I've heard the radio ads, and the issue here is that in Regulation A, prior to qualification by the SEC, that's the point at which the SEC says, no more comments, you can go off and sell your securities now. So up till then, you're just trying to solicit interest. And during that period, up to qualification, you can advertise on TV. You can advertise on the radio. You have to give a disclaimer, which you can say, and tell when the filing has been made with the SEC. You have to say where the offering document can be obtained. But you can do these very, very flashy and almost startling to some people with traditional securities backgrounds. They look and go, what? You're allowed to do that? And the qualification, once you're qualified, at that point, the company's allowed to take money. And because the company's allowed to take money, that's when the rules change. And the SEC says at that point, you can only use methods of communication that include the delivery of the offering document, which of course you can do if you're online. You can have you can click to it, but you can't click on the TV. And that's so you cannot use the TV and the radio under present interpretations by the SEC to advertise your company or your real estate project.
Okay, so that's a really interesting distinction. So prior to getting SEC approval, you can advertise, I'm reading between the lines a bit here, you can advertise in a way that is hard sell, so essentially misleading.
If it was misleading, then there would be different rules. I mean, the rules are, even offers, whatever media, and it's not the SEC you need to worry about in that circumstance. It's plaintiffs' lawyers who are going to go, that's an interesting statement, and then you get sued.
Okay, so not misleading then, but so give me an example. I mean, the headline from this article was invest and get a free lemon squeezer, but I'm not sure that would, I don't know. Don't tell me that's a real one, because I can't imagine anybody being motivated to invest in real estate for a free lemon squeezer.
Or even a set of Ginsu knives. No.
So what can you give me an actual example of what one of those astonishing ads might look like?
The one that got the most print coverage was a well-known actor standing in front of an image of the SEC, which of course they had to change. The SEC objected to that. You can't use the SEC building backdrop. But he was talking about, what would have happened if you had invested in early building backdrop. But he was talking about, what would have happened if you had invested in early stage companies like Uber or Facebook or something like that. And that really got people's attention, because that comparing yourselves to early stage successes that is not a good idea at all. And that's what really got the press coverage. And then we've also seen other companies on the radio. The radio ones and the ones I've heard have been slightly less startling.
All right, so let's talk a little bit about the overall impact of the Jobs Act and of these various regulations. We've not talked much about Regulation CF, which is interesting, isn't it, because of its scale and the audience that it's aimed at. So can you talk a little about that and what you think?
For Regulation CF was the ability for very early stage companies, back of the napkin type companies, to make it easier for them to approach friends and family and fans and say, if you're interested, help us get to the next stage. It's very much seed capital, because it's limited to just over $1 million. And that was the one that grabbed everybody's attention, whereas Reg A has been used by a lot of companies, including real estate companies, because, of course, with a $1 million limit and also a definition of, quote, issuer that would impose that limit on any affiliated real estate project. So if you're the sponsor of Project A, you can't now go and do Project B if you've already raised $1 million on Project A. So it hasn't been used by B if you've already raised $1 million on Project A. So it hasn't been used by real estate very much. There have been 525 offerings so far. Very, very broad range of offerings of types of company. Not all of them successful.
How do you know 550? That's a very good number.
Our intern counted them.
Good. God bless the interns.
Yeah, no, she keeps a spreadsheet. Yeah. So.
And that's across all the portals, is it?
Across all the portals, yeah. There a few portals are pulling ahead of the others. I mean, there are some that have much greater volume than others. There's about 29 portals, if I'm correct.
Yes. How many of them are real estate? You know.
I don't think any of them are pure real estate, actually.
Yes,
for the reasons I mentioned.
Well, actually, okay, sorry, disrespect, but I do know a small change. They're out of Pittsburgh, and they are very much a real estate site. And I've actually interviewed Eve Picker, who is the founder of that site.
We know her, and I should have remembered her. Yes, yeah.
All right, so I'll tell you what, you can fake it, and I'll just edit in that you knew immediately who I was talking about. Don't worry about it. It's totally fine. But it's interesting to me because you're quite right. You know, $1 million doesn't go very far in real estate, but there's a lot of deals below $1 million, and we're talking about $1 million of equity. So $1 million of equity can mean anything up to $3.5 million of deal size.
Mm-hmm. Yeah.
Right.
No.
So it surprises me that there isn't more traffic of CF in real estate.
I totally agree, and I had expected that there would be more real estate action in Reg. CF. I don't know if it's because the platforms are finding that Reg D is, the thing about money is it's the rich people who have it, and so if you're already dealing with accredited investors, maybe that's where you stay. The one thing that I do think might be a damper on real estate is that the problem of affiliated parties not being able to use Regulation F because CF because the definition of issuer in Reg CF is any affiliated parties. So if you've got the same sponsor,
right,
they can only use, they can only raise up to $1.07 million a year. I think that might be part of it because when you look at real estate platforms, you frequently see the same sponsor coming back and back again. But otherwise, I have no answer as to why it hasn't been used more.
Tell you what, let's chat a little bit about the bigger picture for where this is going, and this kind of is going full circle to what we started talking about. And that was, what is the future of the Jobs Act and of these regulations? And we were talking about what might cause, bigger shifts in the regulations, particularly from the real estate perspective. Sarah, where do you think this industry what do you think will happen during and after particularly the next real estate downturn? I mean, you're a compliance expert, and you went through the banking downturn, right, with TARP, and I was inside a bank then. And like you, I saw extraordinary things with paperwork and how deals were structured. And we only really saw it because things went bad, right? If everything had been paid off, no one would ever know.
No,
so
exactly.
What do you think? So tell me, where do you think it's going to go, and what do you think truly you see it in this act? What do you think are the biggest flaws that need resolving and that will only be resolved once there is some kind of major downturn?
That's an interesting question with respect to the flaws. I mean, if I can address the sort of first part first, I think what happens in the next downturn, as Warren Buffett says, is when the tide goes out, you find out who's been swimming without their shorts on. And that's when we will see, when things start getting dodgy, that's when you start seeing who hasn't done the paperwork. Plus, the tragic thing there is that so many of these platforms are so thinly capitalized that when something goes wrong, just one or two deals go completely wrong, people start to lose faith. There isn't going to be anything left for anybody to sue, either on the project or the investors in the platform. There isn't going to be anything left for anybody to sue, either on the project or the investors in the platforms themselves. So I think, the next downturn, you will see evidence of sloppiness, and that will lead to probably a further extinction event of platforms. I think we'll also see, either as a result of downturn or just as the natural course of things, we'll probably see some consolidation of the various platforms. Many of them are just too small, and they're complete niche players, and I think somebody might scoop in there and roll several of them up. With respect to downturns leading to changes in the Jobs Act, not sure whether that would happen, whether people would actually blame the Jobs Act for things going wrong. I hope not. I know there's a lot of defrauding grandmother thing. People who are not fans of Regulation CF. And to the extent that there is a real estate downturn, it's probably going to affect Reg A more than Reg CF at the moment because of who's using it. And Reg A doesn't have the same kind of dodgy reputation. Really hard to predict how that might play out.
Well, in terms of, for example, adding layers of regulation to prevent the kind of sloppiness that you anticipate is probably already in the system. Mandating compliance, for example.
Yeah, or I think that the discipline that any discipline that might come out of any crisis is probably going to come from people suing, which happens a lot faster than regulatory change. And also, so many of these platforms have no insurance, and to the extent that they do get sued, and other platforms think, well, I better get insured against that, I think the insurers are also going to create a level of compliance requirement by saying, no, we want to make sure that you are doing all of these things in terms of your diligence. So change in that area might be more likely to come from the litigation process than the legislative process.
What kind of insurance do sites have, Sarah?
Many of them have nothing. I mean, they're mostly sort of errors and omissions, professional liability type insurance.
And now you have a certification, do you, that you give to people that go through your compliance process?
Yeah, we do for Reg D and Reg CF and Reg A. We've got several different layers depending on the quality, and it includes all of the corporate paperwork that I mentioned, checking liens, checking ownership, checking bad actor status, and so forth.
What are the key daily habits that you have to make you and your business successful?
There is a presupposition there that the business is successful, which it is getting there.
Okay.
I think that one of the most important things is to try and answer inquiries that come in. I mean, the leads that aren't followed up are the leads that are never going to turn into money, and taking care of clients. So, as we are a professional services corporation, so following up and making sure that the rest of the team does. People hate not knowing, even if it's just, I got your email, I'm sorry I can't answer it in full, but I will get back to you by time. I think is a get back to you by time. I think is a discipline that we should, a habit that we should have if we don't.
What has been the hardest lesson you have learned in business in your career? And if you have a real estate story, of course, I'm interested in that, but if not, just in general.
Yeah, not really real estate related, but the one thing that I have found about myself and my own approach is sometimes when I think I'm giving somebody negative feedback, it doesn't come over negative enough. And when I say that's really not the level of performance that I would expect, that should be devastating. And it tends not to be. So maybe I'm just being too English about it. But learning how to emphasize you is one of the hardest things that I've had to do throughout my career.
Well, that's an interesting one. And then my third one is, if you could give one piece of advice to somebody who has not yet invested through the Jobs Act, and again, particularly in real estate, but it's okay if you can't answer specifically real estate, but is considering investing, what would be that advice?
I would certainly advise someone who's looking at online real estate to make sure that they are investing in one of the more active websites. I mean, you want to be investing somewhere where there is deal flow, because where there is deal flow, you've got some assumption that they are not scraping the bottom of the barrel. So you want an active platform with an array of different investments there. And then once you've selected that platform, and once you have looked at what their deal process might be, which you should ask, I mean, you should say, what do you do to make sure that this is a good investment for me or not? And you should also ask whether or not there is a broker-dealer involved, because if there is a broker-dealer involved, you should assume that there is a specific level of diligence happening. And once you've done those things, take a look at the boring stuff. Take a look at the sort of stuff that CrowdCheck does. Could you explain in words of one syllable who owns what and what you are buying? Because not everybody. If you've got a very complex holding structure, are you quite sure that you are getting an investment, whether it's direct or indirect, in the property that you think? So do those things and then cross your fingers.
Exactly.
Sarah and I talked about the concept of the sophisticated investor. The SEC's current definition encapsulates that concept in a standard that relies entirely on the net worth of an individual or on their income. However, those financial definitions, $1 million of net worth, $200,000 of income, etc., were set in place almost 40 years ago and have for the most part not changed. The online course that I've produced covering how to invest in crowdfund real estate deals provides a sophisticated overview of many layers of what it takes to understand a real estate deal when it is laid out in front of you. It won't make you an accredited investor. Only the SEC definition of wealth and income can do that. But it does provide you with an arsenal of tools with which you can frame your investment decisions and be a more prudent and wiser investor. Go to the nationalrealestateforum.org website, NRE Forum information on how you can benefit from crowdfund real estate, either as a sponsor or as an investor. The next podcast is with a guest returning from my first podcast series, Greg McKinnon of the Pension Real Estate Association. He and I discuss a frequently asked question. What is a real estate investment trust, a REIT, and how does it differ from crowdfund real estate investing? You can subscribe to this series on whatever platform you listen to podcasts at the nationalrealestateforum.org website, nreforum.org, and hitting any of the links that I've included about halfway down the page. Thanks for tuning in, and thank you also to Sarah Hanks, CEO of CrowdCheck, for sharing your time with me today. Until next time, this is Dr. Adam Gower, signing off.